Welcome back to the Noob Selling Options channel. I am absolutely thrilled to have you here today. Really quick, before we dive into the thick of it, please do me a huge favor and smash that like button and subscribe to the channel. It genuinely helps us keep bringing you this high-level, actionable market analysis. Okay, so today we have an explainer that's going to completely reframe how you look at the entire semiconductor landscape. We are unpacking the paradox of the $400 billion AI CapEx arms race, and we're pulling the hard data directly from three massive sources today. Amazon's explosive Q1 2026 earnings call transcript, the latest structural CapEx report from Morgan Stanley, and a phenomenal recent semi-analysis deep dive into hyperscaler infrastructure. Think about it. You've got titans like Nvidia, Amazon, AMD, and Intel all literally throwing billions of dollars at custom silicon. Common sense tells us they can't all win, right? Someone has to lose. But what if the pie is expanding so rapidly that they're actually building completely hidden empires right under our noses? We're going to decode this massive structural shift today, taking it all the way from the macro theory down to the exact implications for your options portfolio.
Here's our quick roadmap for today's explainer, so you know exactly where we're headed. We'll start with the $400 billion expanding pie, look at the four distinct growth lanes, uncover Amazon's $20 billion secret, map out the supply chain blast radius, and finally, figure out your very next trading move.
All right, let's kick things off with Section 1, the $400 billion expanding pie. To really grasp what's happening, we have to start with the fundamental macro driver of this entire supercycle, which was detailed beautifully in that Morgan Stanley report: the total addressable market. We are currently right smack in the middle of the token factory build-out phase of AI infrastructure. We are tracking toward an aggregate hyperscaler capital expenditure of $400 billion by 2026. Now, it sounds completely counterintuitive that a massive internal silicon push from a hyperscaler wouldn't just cannibalize the incumbent chipmakers, right? But here is the absolute magic of the expanding pie theory. The overall pie is growing so incredibly fast that the absolute revenue for all of these major players can climb at the exact same time, even as their relative percentage shares of the market shift back and forth. It's wild. They don't have to destroy each other to hit their revenue targets simply because the total volume of compute demanded by the market is multiplying exponentially.
Moving right along to Section 2, the four growth lands.
So how did they survive this arms race without mutually assured destruction? Well, these tech titans have actually stratified the market. They've carved out very specific lanes. Nvidia is the frontier kingmaker. They completely dominate foundational model training, largely thanks to that massive CUDA software moat they've built up. Then you have Amazon AWS acting as the cloud efficiency engine, pushing custom chips to aggressively lower costs for high-volume inference. Next is AMD, stepping in as the merchant silicon alternative. They offer this open-source flexibility for hyperscalers like Meta and Oracle, who desperately want to avoid getting locked into Nvidia's ecosystem. And finally, Intel is playing the wild card. They are heavily pivoting to domestic U.S. foundry manufacturing so they can be the ones physically building all these chips. As long as the capital keeps flowing into the broader market, every single one of them has a distinct path to grow together.
Which brings us to the really juicy stuff. Section 3, Amazon's $20 billion secret.
This was the absolute biggest shocker from the Q1 2026 earnings reports. It is essentially a story of corporate camouflage. Amazon has basically been running a covert operation, successfully masking a world-class semiconductor giant right inside its AWS cloud division. $20 billion. That is the number that completely dropped jaws on Wall Street. Amazon confirmed that its custom silicon portfolio, we're talking Graviton CPUs, Trainium AI accelerators, and Inferentia chips, has officially surpassed a $20 billion annualized revenue run rate. Just let that sink in for a second. They are seeing triple-digit year-over-year growth, and the whole thing grew nearly 40% just quarter-over-quarter alone.
During that Q1 call, CEO Andy Jassy revealed something that really puts this into perspective. He said that if Amazon's chip business operated as a standalone vendor, actually selling chips to the public the same way Nvidia or AMD does, its annual revenue run rate would be roughly $50 billion. $50 billion! That scale genuinely ranks Amazon right up there among the top 3 global data center chip businesses by volume and scale. They aren't just participating in the chip market, they are quietly, methodically dominating a massive slice of it.
But here's the catch, and it's a big one. It is a completely internal powerhouse. Amazon doesn't sell these chips on the open market yet. They deploy them entirely to power AWS, build their own services, and fulfill these massive multi-gigawatt training commitments to top-tier AI labs like Anthropic and OpenAI.
By the way, when we say multi-gigawatt, we are talking enormous, staggering physical power infrastructure. By keeping all of this internal, Amazon secures incredible structural margin advantages. It drastically lowers their CapEx costs and completely strips away external hardware pricing power. Though, I will say, Jassy did drop a little hint that they might eventually sell physical racks directly to third parties down the line, which, if it happens, would be a tectonic shift for the entire industry.
Okay, let's look at the fallout. Section 4. The supply chain blast radius. When a massive player like Amazon successfully vertically integrates its own silicon, which really accelerated after their Annapurna Labs acquisition, it creates this huge blast radius of collateral damage, but also massive new opportunities. You can distinctly divide the market into casualties and beneficiaries. On the casualty side, AMD and Intel are the immediate targets. Intel's legacy data center stronghold is just continuously eroding against Amazon's Graviton processors, which match x86 performance but at a mere fraction of the power cost. AMD takes a double hit here. They're losing server share to Graviton, and they're losing budget AI customers to Amazon's Trainium chips instead of their own MI300s. But then, look at the silent beneficiaries. Taiwan Semiconductor, TSMC, is booking massive, high-margin foundry orders because Amazon sends their designs straight to them for fabrication. And ARM Holdings? Every single time AWS deploys a Graviton rack, ARM is sitting there collecting licensing and royalty fees.
But the real drama, the thing we all need to watch, is the heavyweight clash between Nvidia and Amazon. Look, Nvidia isn't going to be overthrown overnight. Their frontier training power is totally undisputed right now. However, Amazon now has a very credible bargaining chip. AWS doesn't have to buy as many ridiculously expensive Nvidia GPUs if it can just offload everyday inference onto its own native Inferentia chips. And if AWS can offer AI compute on Trainium at a massive 30 to 40% discount compared to renting an Nvidia H200 or B100 instance, you better believe startups are going to migrate to save cash. That is a real game changer. This forces Nvidia to fiercely defend its margins as inference becomes a much larger piece of the overall AI pie.
And this localized battle is completely accelerating the broader cloud arms race. Amazon's $20 billion run rate totally validates Alphabet's long-term strategy with their tensor processing units, or TPUs, which they've been using internally for years. But for Microsoft, this is a literal five-alarm fire. Microsoft is slightly behind in the custom silicon race, and Amazon's success puts immense margin pressure on Azure. It is forcing Microsoft to aggressively scramble and ramp up the rollout of their own Maya AI accelerators just to keep pace with the market.
Finally, Section 5. Your next trading move.
So what does this all mean for us? How do we take this wealth of macro supply chain data and actually apply it to the noob selling options trader mindset? Understanding that the hardware market is heavily stratifying right now and that vertical integration by hyperscalers is actively compressing the growth avenues for traditional chip designers, well, that is exactly the edge you need. Which leaves us with this final, vital question. Your homework for today. Given this massive structural threat, knowing that AMD is taking hits on both the CPU server front against Graviton and the budget AI front against Trainium, does this alter how you select your strike prices and expiration dates for your cash-secured puts on companies like AMD? Think about it. If their total addressable market in the data center is being aggressively squeezed by the very hyperscalers they are trying to sell to, how does that change your risk modeling? I really want you to think deeply about how this expanding, yet highly segmented pie impacts your portfolio weighting. Please drop your strategies and thoughts in the comments below. I want to hear from you. Thank you so much for learning with me today. Remember to subscribe, and I will see you in the next explainer.